Hello market newbies, welcome to our intermediate trading series. This is our lesson 6. In our last lecture, we discussed support and resistance levels. In this lecture, we will talk about two very popular indicators, Bollinger Bands and MACD. First, let's talk about Bollinger Bands. In the figure showed here, Bollinger Bands consist of a center line, or we can call it middle band. It is a moving average, normally the 20 moving average, and two price bands above and below it. We also call them upper band and lower band. Normally, there are two standard deviations from the center line. As the market price moves up and down, the Bollinger Bands do so as well. There are a number of uses for Bollinger Bands, including determining overbought and oversold level, following trend, and monitoring for breakouts. A common strategy using Bollinger Bands is to identify overbought and oversold condition. When the price of the asset breaks below the lower band, a trader may enter a long position, expecting the price to revert back to the middle band. When the price breaks above the upper band, a trader may short the exit, betting on a move back to the middle band. This type of strategy relies on the mean reversions of the price. Mean reversion assumes that if the price deviates substantially from the mean, it eventually reverts back to the mean price. Bollinger Bands identify exit values, prices that have deviated from the mean by the upper and lower band. This strategy works well in a range-bound market, as prices travel between the two bands like a bouncing ball. We learned the wave principles in our past lessons, and if to use the waves terminologies, we can say that this strategy will work in the corrective waves, like wave 2, wave 4, and wave B. However, if you try to apply this strategy in the trend market, you will find yourself always completely wrong. Let's assume that we have a trend market here, like the one that we show here. If you still apply the overbought and oversold strategy and sell once the price touches the upper band, for many times you will find yourself completely wrong. Then, what should we do in the trend market? One way we can do is to only open position that follows the trend. For example, if the trend is up, like the one we show here, only take long position when the lower band is tagged. But when is the time to close the position? Definitely not once the middle band is tagged, because trend can last for a very long period of time and you want your profit to run. One of the many good ways is to check the chart that has one level time frame up. For instance, in this scenario, the chart is a 30-minute chart, and you may want to look a level up like 2-hour chart. You may sell when the lower band of the 2-hour chart is tagged. The other way is to combine with other indicators to find an exit point, like MACD. We will show you how to do so when we talk about MACD later. Another strategy using Bollinger Bands is called a squeeze strategy. A squeeze occurs when the price has been moving aggressively, then starts moving sideways in a tight consolidation. As we can see from the figure, the part that is highlighted by the rectangle is squeeze, as the upper band and lower band get closer together. This means the volatility of the asset has been decreased. After a period of consolidation, the price often makes a larger move in either direction, ideally on high volume. Remember, squeeze in Bollinger Bands only tells you the price is going to have a big move. it doesn't tell you the direction. It may go up or go down. You have to check the big trend. If the trend is going up, then the squeeze is a strong indication for the price going up again with a dramatic speed. You might want to buy once the middle band or the lower band is tagged and ride the tide. This strategy is best to use in impulsive waves. For instance, if you think an impulsive wave is ongoing and you want to jump in to catch a certain profit, you may wait for the appearance of the squeeze and buy there. Now, let's move to another very popular indicator, moving average convergence divergence, also called MACD. MACD is a trend following momentum indicator that shows the relationship between two moving average of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period exponential moving average. The result of that calculation is the MACD line, as the blue line in the figure. A 90 EMA of the MACD is called the signal line, represented as the orange line in the figure. There is also a zero line representing zero, as shown in the figure. The green and red bars in the figure are MACD histogram, which is the result of MACD line minus signal line. Green bar indicates a positive value and red bar represents a negative value. One of the most common strategy about MACD is crossover strategy. A bullish crossover occurs when the MACD turns up and crosses above the signal line. A bearish crossover occurs when MACD turns down and crosses over below the signal line. Basically, what this strategy does is to buy at a bullish crossover and sell at a bearish crossover, just like illustrated in this figure here. When you see a bearish crossover, you sell, and when you see a bullish crossover, you buy. You probably noticed that if you count all the crossovers in this chart, and this is the 30-minute chart of S&P 500, by the way, there are more than 10 of them, and at least half of them are false alarms, which means if you use such a strategy, you might end up losing money. Therefore, we have to know when to use this strategy. First, this strategy is more suitable for range-bound market, or in Elliott wave term, corrective waves. In trend market, you can only use half of them. This is very similar to when we talked about Bollinger Band, overbought, and oversold strategy. So, for example, in a bullish trend, you can only use the bullish crossover to help you find the buying point, but don't use the bearish crossover to help you find the exit point. And in a bearish market, the opposite is suitable. Second, use strategy on longer time frames, for example, 30 minutes and above. This is due to the lack of the signals. For instance, when the bearish crossover appears, the real price already dropped a certain amount, same as the bullish crossover. If you use too short of time frame, like 1 minute or 5 minute time chart, you might not leave enough margin to give yourself a profit. Also, if you use too short time frame, you might find yourself trade too much and find too much false alarm. When the MACD forms highs or lows that diverge from the corresponding highs and lows on the price, it is called a divergence. A bullish divergence appears when the MACD forms two rising lows that corresponds with two falling lows on the price. When the MACD forms a series of two falling highs that correspond with two rising highs on the price, a bearish divergence has been formed. This figure shows the weekly chart of S&P 500 during the financial crisis from 2008 to 2009. We can clearly see a bullish divergence at the end of 2008 to March 2009. The bearish divergence happened from mid-2007 to late 2007. Many traders use bullish divergence to buy and bearish divergence to sell. They sometimes find themselves making big profit, and sometimes they don't. So they blame that MACD divergence isn't a very reliable technique. The first argument we like to say here is that it's hard to detect divergence when you are still in the middle of it. One situation is that you think it is a divergence, but later it turns out it's not. It's always easy to go back to historic charts and say, hey, that's a divergence. But what really matters is that if we can detect the divergence when it's still ongoing. Therefore, we should say we should say that we need to practice more on our skills on how to detect it. We might consider also to use other indicators to help. For instance, if you suspect a bearish divergence, but the trading volume is actually still very high, then it's unlikely that eventually it's going to have a divergence there. The second argument that we would like to say is that we have to be prepared of what will happen after divergence. We have to bear in mind that when a divergence appears, no matter bullish or bearish, we can expect the price will later go towards the opposite direction. However, we don't know how far it will go. The two examples here actually shows how dramatically the price of the opposite direction can go, but they are not always the case. If you are careful enough, you will probably notice that in this chart there was a bullish divergence in the middle of 2008. After the bullish divergence, the price only went up for 4 to 5 weeks, and then and this is very weak. After that, it's a big plunge down again. To conclude, the divergence is a very useful technique. However, it's suggested that you combine other techniques to help you detect a real divergence. And we have to bear in mind, after a divergence, the price goes for the opposite directions, but it might not always be very dramatic. You have to be very careful and make certain protections. For example, setting up a stop loss once the opposite move is actually very weak. Let's move up to another topic. Many traders have experience like this. They bought some very good stocks. However, they ended up selling them too soon. The stocks went double, tripled, or even tenfold of the price after they sold. Or the market went crashed, like 2008 financial crisis, when the market dropped 20%. They thought it's a very good opportunity to buy, and they actually buy there. But later, they found themselves still buying too soon. How to solve this kind of problems? There's one simple way. That is by using the zero line in MACD. This method is very simple. We can define MACD line above the zero line as bullish market, when MACD line below the zero line as bearish market. We will still use the weekly chart of S&P 500 as our example. We can see from the charts we give out an example of a bullish market and an example of bearish market that agrees with the definition. By the way, we didn't highlight it all in this chart, just to save time. The rule is very simple. In the bearish market, you will only sell or hold short position, and in bullish market, you will only buy or hold long positions. Using this method, though you won't be buying or selling at the lowest points or the highest point, it is still a very good way to keep your profit run. One question remains is that what time frame we should be using. Actually, it really depends. If you are a long-term trader, you might want to use weekly charts or monthly charts. If you are medium-term traders, you might want to use 4-hour or daily charts. If you are short-term traders, you might want to use 30-minute charts. So let's assume you are long-term traders. You are a long-term trader and use weekly charts as your basic time frame charts. You bought Nvidia stock in 2005 when weekly MACD line moves above the zero line, which means by definition the stock became bullish. The price you bought the stock was around 22. If you stuck with the rule here, you shouldn't be selling until almost the end of last year, which is 2018, when the weekly MACD line dropped below the zero line at price around 220. You would have tenfold your initial capital after 3 years. You won't buy it again until the weekly MACD line moves above the zero line. Still remember our previous example when we talk about Bollinger Bands? We want to combine with MACD to find an exit point. The answer is to use the rule that we just talked here. You should keep the position until the MACD line drops the zero line as represented in the figure. Finally, let's recap what we learned in this lesson. We learned two very popular indicators, Bollinger Bands and MACD. For Bollinger Bands, we learned two strategies. The first one is overbought and oversold strategy. To put it simple, this strategy is to buy at lower band and sell at higher band. This strategy is good for range-bound market. For trend market, we only use the Bollinger Bands to find the support level or resistance level, which means in the trend market, we only open position that in favors of the larger trend and let the profit run. The second strategy is squeeze. Squeeze is a very special pattern in Bollinger Bands. It tells you the price is going to have a very dramatic move in either direction. You have to combine with the larger trend to see what direction it is most likely to go and open position accordingly. For MACD, we learned three strategies. Crossovers. Buy at bullish crossover and sell at bearish crossover. Again, this strategy is good for range-bound market. A bigger time frame, for example 30 minutes and above, is suggested. Use only bullish crossover in bullish trend and use only bearish crossover in bearish trend. Divergence is a very useful technique in finding lows and highs, but it needs practice. Use other tools to help you find the correct divergence. Divergence only indicates a price movement in the opposite direction. It does not guarantee that the opposite movement will be very dramatic. Be careful when the opposite movement is very weak and make certain protections. Finally is the zero line strategy, which is very useful if you believe there is going to have a certain trend and you want to keep the profit run. In the bearish market, you will only sell or hold short position, while in bullish market, you will only buy or hold long position. In our next lesson, we will talk about value stocks. For more educational videos, visit www.marketnewbie.com. Follow us on Facebook and Instagram. Also, don't forget to subscribe to our YouTube channel. See you in our next lesson.